Imagine two families. Both live in the same prosperous city, both run successful businesses, and both, by the end of their long and fruitful lives, have built a net worth of exactly $10 million. The first family, let's call them the Millers, did what most people think is responsible. The patriarch, Mr. Miller, hired a lawyer and drafted a detailed will, leaving everything to his two children. He felt secure, believing he had done his duty. The second family, the Chengs, took a different path. Mrs. Cheng also met with a lawyer, but instead of a will, she created a different kind of legal structure. Her children were still the beneficiaries, but the mechanism for the transfer of her wealth was entirely different. When Mr. Miller passed away, his family was immediately thrown into a legal labyrinth. His will had to be validated by a court in a process called probate. The court proceedings were public, revealing every detail of the family's assets to the world. Lawyers' fees and court costs began to pile up, chipping away at the inheritance. After 18 long months of delays and legal bills, the Miller children finally received their inheritance, but nearly $1 million of their father's legacy had vanished into legal fees and administrative costs. When Mrs. Cheng passed away, her children made a phone call. There was no court, no public record, no delay. Within weeks, the full $10 million of her mother's legacy was transferred to them, seamlessly and privately. Not a single dollar was lost to the probate process. The story of the Millers is not an exception. It's a tragically common tale. Studies have shown a staggering pattern of wealth destruction. According to multiple sources, including Forbes and a landmark 20-year study by the Williams Group, an estimated 70% of affluent families lose their wealth by the second generation. By the third generation, that number skyrockets to 90%. This phenomenon is so common it has a name across cultures, from shirt sleeves to shirt sleeves in 3 generations. The question is, why? It's not always due to bad investments or lavish spending. So what did the Chengs know that the Millers didn't? The answer is one word: trust. For centuries, this has been the primary instrument the world's wealthiest families use, not just to pass on their assets, but to protect them, preserve them, and grow them across generations. And in this video, we are going to pull back the curtain. We will explain exactly what a trust is, demystify the critical differences between the types of trusts, and reveal the advanced strategies the ultra-wealthy use to legally shield their billions from taxes, lawsuits, and the erosion of time. This is not just a lesson in finance, it's a lesson in legacy.
So, what exactly is a trust? The word itself can sound intimidating, exclusive, something reserved for people with household staff and private jets. But at its core, a trust is a surprisingly simple concept. Think of it this way. A trust is a private company you create for your family's assets. It's a legal entity, a financial safe deposit box that comes with a custom-written rule book. Instead of your assets being in your personal name, you transfer them into the name of this private entity. This simple act of changing ownership is the foundation of all its power. And every trust has 3 main characters, a cast of players you need to understand. First, you have the grantor. This is the founder, the architect of the trust. It's the person who creates the trust and transfers their assets, like real estate, stocks, or business interests, into it. If you are setting up the trust, you are the grantor. Second, you have the trustee. Think of the trustee as the CEO of this private company.
Their job is to manage the assets held by the trust according to the rules laid out in the rule book, the trust document. The trustee has a fiduciary duty, a legal obligation, to act in the best interests of the beneficiaries. A trustee can be a person, like a spouse, an adult child, or a trusted advisor. Or it can be a professional institution, like a bank or a trust company. And third, you have the beneficiary. These are the people for whom the trust was created. They are the shareholders who will ultimately receive the benefits from the assets in the trust, whether it's through regular income distributions or an eventual inheritance. Grantor, trustee, beneficiary. The creator, the manager, and the recipient. Now, why go through the trouble of creating this structure? The single most important benefit for almost everyone is avoiding probate. We saw what happened to the Miller family. Probate is the default legal process for validating a will and distributing assets after someone dies, and it is a nightmare. First, it's incredibly slow. In many states, it can take a year or even longer to settle an estate. During this time, the assets are often frozen. Second, it's expensive. Lawyer fees, executor fees, and court costs can easily consume 3 to 8% of an estate's total value. On Mr. Miller's $10 million estate, that could be up to $800,000. And third, it is completely public. Every asset you owned, every debt you owed, and who you left your money to becomes a public record available for anyone to see. This can invite unwanted solicitations, family disputes, and claims from potential creditors. A properly funded trust bypasses probate entirely, because technically, you don't own the assets when you die. The trust does. The trust is the owner, and it has a clear rule book for what to do. There is no need for a court's permission. The process is fast, it is inexpensive, and most importantly, it is completely private. This one benefit alone is why financial advisors often say that anyone who owns a home should, at the very least, consider a basic trust.
Once you decide to create a trust, you face the most fundamental choice of all. It's a fork in the road that determines everything about the trust's power and purpose. This is the choice between a revocable and an irrevocable trust. Let's start with the most common type, the revocable living trust. Think of this as sandbox mode. A revocable trust is incredibly flexible. While you, the grantor, are alive and well, you are in complete control. Typically, you name yourself as the initial trustee, and you remain the primary beneficiary. It's your money, your assets, and you can do whatever you want with them. You can put assets in, take assets out, sell a property owned by the trust, or even change the terms of the trust entirely. You can decide you want to leave more money to one child, or write another one out. You can even cancel or revoke the entire trust if you change your mind. So what's the point? The primary purpose of a revocable trust is, as we discussed, to avoid probate. It's an administrative tool for the smooth and private transfer of wealth upon your death. When you pass away, your designated successor trustee steps in, and the trust becomes irrevocable. They then follow your instructions to manage and distribute the assets, all without a single court filing. But, and this is a critical but, a revocable trust offers almost zero asset protection while you are alive. Because you maintain full control, the law sees the assets in your revocable trust as your personal property. This means they are completely vulnerable. If you are sued, a creditor can come after the assets in your revocable trust. For tax purposes, all income generated by the trust is reported on your personal tax return. And a revocable trust does nothing to reduce estate taxes. It's a tool for managing your estate, not for shielding it. Now let's talk about its powerful counterpart, the irrevocable trust. If the revocable trust is a sandbox, an irrevocable trust is Fort Knox. As the name implies, an irrevocable trust is permanent. When you, the grantor, transfer assets into an irrevocable trust, you are making a profound legal statement. You are giving up control. The assets are no longer yours. They are owned by the trust, a separate legal entity, and you cannot easily change the terms or take the assets back. Why on earth would anyone do this? Because this is where the magic of asset protection and tax minimization happens. Since the assets are no longer legally yours, they are generally shielded from your personal creditors, from lawsuits, and from divorce settlements. If you are a surgeon, a business owner, or anyone in a high liability profession, an irrevocable trust can be a fortress that separates your personal wealth from your professional risk. And this is the key to the strategies of the super rich. For tax purposes, the irrevocable trust is a separate entity. This means it can be used to move assets and all of their future growth out of your estate, dramatically reducing or even eliminating federal estate taxes, which can be as high as 40% on large estates. This is the fundamental trade-off. A revocable trust offers you complete control, but no protection. An irrevocable trust offers you immense protection, but requires you to give up control. Understanding this distinction is the key to understanding the entire world of legacy planning.
Now we move from the fundamentals to the masterclass. How do the ultra-wealthy use these tools, specifically irrevocable trusts, to achieve results that seem almost impossible? They use specialized versions, each designed for a specific purpose. Let's look at the first one, the ILET, or Irrevocable Life Insurance Trust. Life insurance is a common tool. Many people have a policy to provide for their families. But here's the trap. If you personally own your life insurance policy, the death benefit payout is included in your taxable estate. For the wealthy, this can be a disaster. This brings us to our first case study, the Miller family's $2 million tax save. Let's imagine John Miller, a successful entrepreneur with an estate worth $20 million. He has a $5 million life insurance policy. If he owns that policy himself, upon his death, his estate is now valued at $25 million. This is well over the federal estate tax exemption. At a 40% tax rate, the IRS would claim a staggering $2 million of that insurance payout. His family, who he intended to provide for, would only receive $3 million. Now, the wealthy way. Instead of owning the policy himself, John creates an ILET. The trust is the owner and the beneficiary of the $5 million policy. John makes annual gifts to the trust, and the trustee uses that money to pay the policy premiums. When John passes, the $5 million is paid directly to the trust. Because John didn't own the policy, the payout is completely outside of his taxable estate. The full $5 million is available to his family 100% free of both income and estate taxes. By using this structure, he saved his family $2 million. It's a simple change in ownership that makes a multi-million-dollar difference. Next up, a strategy that sounds like financial alchemy, the SLAT, or Spousal Lifetime Access Trust. This is often called the Have Your Cake and Eat It Too trust. A major drawback of an irrevocable trust is the loss of access to your money. A SLAT is a clever way around that. Here's how it works. One spouse, let's say the husband, makes a gift of assets into an irrevocable trust. The beneficiary of this trust is the other spouse, the wife. Let's look at our second case study, the Garcia's financial fortress. Maria and David have a $35 million estate, which is over the current combined estate tax exemption for a couple. They are worried about future estate taxes. Maria decides to move $5 million of their high-growth investment portfolio into a SLAT for David. Immediately, two powerful things happen. First, that $5 million, and crucially all of its future growth, is now legally outside of their combined estate. They have permanently shielded that wealth from future estate taxes. But second, and this is the genius of the SLAT, the family hasn't lost access to the money. If they need funds, the trustee can make distributions to David, the beneficiary. Because they are married, the money flows back into the household. It allows a family to get assets out of their taxable estate while maintaining an indirect safety net. It's a sophisticated move that provides both a tax shield and financial flexibility. Now for one of the most powerful wealth transfer tools ever devised, the GRAT, or Grantor Retained Annuity Trust. This is the wealth-shifting machine, a favorite of tech entrepreneurs and investors with fast-growing assets. The concept is a bit more complex, but the result is breathtaking. The grantor puts an asset that is expected to appreciate rapidly, like pre-IPO stock or a real estate development, into a short-term trust, usually for 2 or 3 years. The trust is legally structured to pay the grantor back the initial value of the asset, plus a small amount of interest set by the IRS in the form of an annuity. Whatever is left in the trust at the end of the term, the appreciation, goes to the beneficiaries, typically the children, completely tax-free. This brings us to our case study, the tech founder's masterstroke. Imagine a tech founder. Let's call her Anna. She has $10 million worth of stock in her private company, which is expected to IPO in the next few years. She transfers this stock into a 2-year GRAT. The GRAT is structured to pay her back her $10 million plus a nominal interest rate over those 2 years. In essence, she has made a zeroed-out gift. A year later, the company has a wildly successful IPO. Her stock, still inside the GRAT, is now worth $50 million. At the end of the 2-year term, the GRAT fulfills its obligation and pays Anna back her approximately $10.5 million. But the remaining $39.5 million in pure, explosive growth, it passes directly to her children, completely free of any gift or estate taxes. She has effectively teleported nearly $40 million of wealth to the next generation, legally sidestepping a potential tax bill of almost $16 million. This is how fortunes are transferred. Finally, the ultimate instrument for long-term legacy, the Dynasty Trust. If other trusts are about planning for your children, the Dynasty Trust is about planning for your grandchildren, your great-grandchildren, and beyond. This is how families create a family bank that can last for a century or more. The problem with inheriting wealth is that it gets taxed at every generation. Let's look at our final case study, the family bank blueprint. The old way. A billionaire leaves his fortune to his son. The son's estate is massive, and upon his death, 40% is wiped out by estate taxes. The son then leaves the diminished fortune to his daughter. Upon her death, another 40% of what's left is wiped out again. The family fortune is like a block of ice melting under the sun with each passing generation. The Dynasty Trust way. The billionaire puts his fortune in a dynasty trust. The trust provides for his son's needs, education, health, starting a business, through distributions. The son lives a comfortable life, but he never legally owns the underlying assets. When the son passes, his name is simply removed as a beneficiary, and his children, the grandchildren, become the new beneficiaries. Because the son never owned the assets, there is no estate, and therefore no 40% estate tax is triggered. The trust continues, providing for the grandchildren. This process can repeat for generations, preserving the family's capital in a way that is simply impossible with direct inheritance. It's the difference between giving your family a fish and giving them a perpetually stocked, tax-proof lake.
The world of trusts is filled with misconceptions. Let's clear up a few of the most common ones. Myth number 1. Trusts are only for billionaires. This is the most pervasive myth of all. As we've seen, the primary benefit of even a simple revocable trust is avoiding probate. Anyone who owns a home has a significant asset that will be forced through the slow and expensive probate process unless it's held in a trust. A basic trust can be one of the most valuable investments a middle-class family can make to protect their most valuable asset for their heirs. Myth number 2. If I create an irrevocable trust, I lose my money forever. This is a valid fear, but it's not entirely accurate. As the SLAT strategy shows, there are ways to structure trusts where the family retains indirect access. Furthermore, trusts can be drafted with specific provisions. For example, a grantor can retain the right to swap assets of equal value in and out of the trust, providing a degree of flexibility. While you do give up direct control, a skilled attorney can build in mechanisms that align with your family's long-term needs. Myth number 3. A will is good enough. A will is absolutely better than nothing, but a will is essentially a set of instructions for the probate court. A will guarantees probate. It does not provide any asset protection from lawsuits. It does not help you minimize estate taxes, and it does not protect your family's privacy. A will is a letter to a judge. A trust is a private contract that keeps you out of court altogether. Today, we have journeyed from the basic definition of a trust to the sophisticated strategies used by the world's most successful families. We've learned that a trust is not some mysterious financial product, but a powerful legal tool, a tool to bypass the costly and public process of probate court, a tool to shield your life's work from unforeseen liabilities, and a tool to intelligently and legally minimize the burden of taxes, ensuring that your legacy reaches the people you love intact. The core lesson is the trade-off between control and protection. A revocable trust gives you total control, but little protection. An irrevocable trust offers the ultimate protection at the cost of that control. We've covered some complex strategies today, and we'd love to hear from you. What was the most surprising thing you learned about trusts? Do you have any questions or experiences with estate planning you'd like to share? Let us know in the comments below. Your insights could help the entire community. But it is crucial to understand this. This video is for educational purposes only. It is not and should never be considered legal or financial advice. The world of estate planning is complex and deeply personal. The laws vary by state and change over time. The single most important step you can take after watching this video is not to try and implement these strategies yourself, but to seek out a qualified, experienced estate planning attorney in your area. They are the only ones who can help you design a plan that is right for your unique situation, your assets, and your family's future. As the proverb says, the true meaning of life is to plant trees under whose shade you do not expect to sit. Building wealth can take a lifetime. Protecting it takes a plan.